Hello traders, you are welcome back to the Forex Geek channel. In this video, we are going to be talking about an effective momentum indicator that adapts to changing market conditions, and the indicator we are going to be looking at is the dynamic momentum index. All right, we're going to be looking at the dynamic momentum index, or the DMI for short. So unlike traditional momentum tools, this indicator does not rely on a fixed period. Okay, instead it adjusts based on market volatility. This means more accurate signals and better adaptability in both trending and ranging markets. Okay, let's just quickly dive into how it works and how you can apply it to your trading strategy. Now, the dynamic momentum index, or the DMI, is a modified version of the relative strength index, or the RSI. Okay, and it is developed to improve accuracy by adjusting its period dynamically. In simple terms, it shortens its calculation period in volatile markets and extends it when the market is stable. This adaptability makes it superior to traditional fixed period indicators, which often generate misleading signals in varying conditions. Basically, when volatility is high, the DMI becomes more responsive, catching momentum shifts faster, right? Then when volatility is low, it smooths out signals to prevent unnecessary noise. So this dynamic nature makes it particularly useful for avoiding false breakouts and confirming strong trends. Okay. Now, dynamic momentum index uses standard deviation to measure volatility based and based on this volatility, it adjusts the number of periods used in its calculation. This means that during sharp price movements, the indicator updates faster, helping traders react in real time. So now let's just quickly look at the functionality of this indicator. So basically, if the DMI rises above 70, it suggests an overbought market. All right, and if the DMI falls below 30, it signals an oversold market. Okay, however, unlike the RSI, the DMI adjusts dynamically, making these signals more reliable. Okay, but it doesn't mean that the indicator is 100% accurate, right? There could be some false signals still. Okay, this feature allows traders to reduce false signals and focus on high probability trades regardless. Now, one of the best ways to use the dynamic momentum index is for trend confirmation and reversals. Here's how. For trend confirmation, if the DMI is above the 50 level, right? The 50 level here, the midpoint. If the DMI is above 50 and rising, like what we see happen here. If the DMI is above 50 and rising, it suggests strong upward momentum, right? If it's above 50 and rising, it suggests strong upward momentum. But if the DMI is below 50 and falling, it indicates strong bearish momentum. Okay, so that is for trend confirmation. Then for divergence trading, when price makes a new high but the DMI does not, when price makes a new high but the DMI does not, like what we can see happen here, right? But you can see that the DMI made a lower high instead. So it could signal a potential reversal. Such scenario is what we call a divergence, and you can see that we actually had a decline to the downside eventually. Okay. On the other hand, when price makes a new low, right? Let's see if we can find that example. When price makes a new low, if price makes a new low but the DMI makes a higher low, it may indicate a market bounce. That is a reversal to the upside. In that case, it's going to be it's going to be a, okay, I think we had something like that here. In that case, it's going to be a bullish divergence. So you can see we had a reversal to the upside. Okay, then you can also combine the DMI with other indicators. The DMI works well with moving averages, for confirming trends. Okay, you can actually use the DMI with moving averages to get your trend confirmations, and you can also pair the DMI with Bollinger Bands, to help you filter out false breakouts, or you can use it alongside MACD to add further confirmation for momentum shifts. Okay, so supposing you are analyzing gold like we are doing right now on the 15-minute chart, and maybe you notice that the price is approaching a support zone, right? You can see that there's actually a support around here. So maybe you notice the price is approaching a support zone, and maybe the DMI is towards the oversold zone that is below 70. It actually entered oversold zone and then it just rose above it a little. All right, so this suggests that price may be due for a move to the upside, right? It indicates that we could actually have a move to the upside, right? At least to the next major resistance, probably to the next major resistance. Okay. However, instead of immediately entering a buy trade, you wait for confirmation from a bullish candlestick pattern or an additional indicator, right? Maybe if you are using moving average or RSI or any other indicator of your choice, you can just watch out for a buy signal from the indicator as well. Okay, so by using the DMI in this way, traders can avoid premature entries and focus on stronger signals. So if you get a buy confirmation, probably after getting your bullish confirmation, you can set your stop loss below the swing low, and then your take profit can be at the next resistance. The take profit can actually be at the next resistance zone. Okay, and you just ensure that you have a good risk to reward ratio. All right. So the dynamic momentum index is an advanced trading tool that adapts to changing market conditions, giving traders an edge over traditional momentum indicators. Its ability to dynamically adjust period settings based on volatility makes it highly effective for confirming trends, detecting reversals, and filtering out weak signals. If you found this breakdown helpful, make sure to smash that like button and subscribe for more technical analysis strategies. Turn on notifications so you never miss out on valuable trading content. Drop a comment below. Have you used the DMI in your strategy? Let us discuss. Happy trading, and I'll see you in the next video.